started to learn about balance sheets and cash flow statements and income statements and putting together models and analyzing companies. And that has led me to on a 25-year journey in analyzing companies and building portfolios in one way or another. Focus on companies that are innovating, but that are also at the beginning edges of this new product cycle. If you bought the market on the worst day before the financial crisis in 2007, before it really hit in 2008, you're the worst investor. You bought at the peak. The next year, the thing just goes, you're up like 300% today.
Hi, my name is Jason Raznick, the CEO of Benzinga, and welcome to the Raz Report. As always, before we kick things off, I want to quickly tell you about what Benzinga is. Before I started Benzinga in 2010, there were very few places to get real-time information on financial markets. I thought it was unfair that Wall Street had access to this information before the average Joe investor. So I created Benzinga to level the playing field for you, the retail investor. Benzinga is for the people and by the people. Now, let's dive into the show. All right, welcome to this edition of the Raz Report. I'm excited and looking to learn from Terry Gardner, investment advisor, portfolio strategist at CJ Lawrence. Terry, thank you for coming on the Raz Report today.
Great to be here, Jason. Thanks for inviting me.
Thank you. So Terry manages a lot of money, has a lot of different strategies. You can see more about CJ Lawrence at cjlawrence.com, where Terry works. But I just want to jump right into it. We were talking stocks, and this will go over the place. We'll talk about your career, but I'm just going to skip this one and start with a strategy question. You were talking about innovation, investing in innovation. What do you mean by that?
Yeah, so by the way, we invest in individual stocks and bonds. So a lot of managers focus on specific ETFs and funds. We dig deep into the specific securities. And so what gets us excited in terms of investing is investing in growth and in innovation. And what we have found, Jason, is that there's an opportunity to buy innovation at a reasonable price. We call it IRP, innovation at a reasonable price, IRP investing. And the benefit of IRP investing is that you invest in companies that are driving innovation, driving disruption, but trade at a reasonable stock multiple, cash flow multiple, have strong balance sheets. And that's different from past cycles. For instance, the Nifty 50 era back in the 1960s, those stocks were trading at 60, 70, 80 times earnings on the back of earnings that were considered premium and predictable. And that all ended in the 1970s with the onset of inflation. And then we ushered in another period in the 90s on the back of the internet bubble, where companies were receiving these premium, sometimes outlandish valuations based on very sketchy business models. And then that bubble burst. But what's different today is that you can buy companies, and we'll throw out a couple of names, and they're household names, like a Microsoft, like an Amazon, that are growing their businesses, that trade at a multiple that you can kind of get your arms around, but are driving the innovation or on the cutting edge, whether it's artificial intelligence or cloud computing. They're on the cutting edge of disruption and innovation. So that's the IRP, innovation at a reasonable price strategy.
Okay, so right now you think there's opportunities with innovation at a reasonable price, because as you define the letter symbols, and we talked about GARP, growth at a reasonable. So innovation at a reasonable price, is part of the focus AI?
Of course it is, right? And, AI really isn't all that new. We've been talking about AI for a long time. Mm-hmm. What it is, it's probably the next wave of innovation on the back of what was, cloud computing and Fortune 500 companies moving to the cloud and just compute power. There are a number of technological advances or technology advances that we've experienced over the last decade or two. AI is certainly the next one and likely to be transformational. And that's why we're also focused on the back of IRP on product cycle, not so much market cycle. So you and I haven't talked about the market just yet, but our point is, and what we try to stay focused on and what your listeners should stay focused on is, don't get too wrapped up around where you think the market is. Is it too expensive? Is it not? Focus on companies that are innovating, but that are also at the beginning edges of this new product cycle. And that's the excitement for us around AI and what that's going to bring over the next couple of years.
So when you look at companies on that new product cycle or what have you, what are some of those ones that you highlight? Are they all big ones? I know you mentioned Microsoft earlier. Are they all like, is it NVIDIA's, or do you have other ones that maybe people aren't talking about?
So they are the big ones for sure. They're the leaders, right? And you can't ignore them, even though they're
and by the way, I'm not saying those are bad, because like
yeah.
I worked for a financial advisor many years ago, and this was going back 25 years ago, and I remember they had a list of the Disney's, Apples, and like just like companies that are stable, like well-known American companies. And when you buy those baskets, if I bought them 25 years ago and kept them, you're doing really well, right? So I'm just, I want to, yeah. So, but continue.
Point well taken. And some will say, look, that's a crowded trade. Okay, it's a crowded trade, but they're the best companies in the world, right? So, so don't ignore them, right? Someone once told me, don't cut your dandelions and water. Don't water your dandelions and cut your flowers, right? So those are the flowers. Keep watering them. And certainly, as to your point, look outside that sphere a little bit, outside of the Magnificent Seven. And there are companies, but it's important to kind of break AI into kind of two components, one being infrastructure, another being apps, right? And there'll be participants in the ecosystem around those categories. And we would consider even like an Oracle to be in the infrastructure side of the equation. But there's a couple of companies that utilize AI today to drive their business. Certainly, Meta would be one, and it's widely known, but people are pretty focused on Threads because that's kind of exciting and what they're doing in Reels. But remember, when Meta got in trouble, they got in trouble because they were utilizing personal data. And the push from the regulators was stop using everyone's data. So Meta started to really generate AI, or to advance AI to generate new recommendations for their market participants. So that we think they're kind of the closet AI leader. But even companies like Intuit, right? INTU, the symbol. Intuit's an interesting name, right? Everyone knows TurboTax and Credit Karma and MailChimp are some of their brands. They use a lot of AI to generate leads, to generate business opportunities, to generate business steps and actions to be taken by small businesses. So there's a user of AI that probably doesn't fit within that Magnificent Seven AI sphere. Another one, which has kind of actually stumbled today or yesterday on earnings report, is Rockwell Automation, right? So Rockwell, and they stumbled because they didn't meet expectations because they aren't actually able to procure enough raw materials and products to stay up with the demand in their business. But Rockwell develops machines and devices in the virtual world that can then be put to use in the real world. So if you and I are building a factory and we want to know what is the type of machine we need to build our new sneaker, Rockwell Automation will come in and help design that based on friction points and mathematics and physics in the virtual world using AI before actually even creating a prototype physically. So that's pretty interesting in our perspective.
How long have they been, like, is Rockwell one you've been following for a while?
We've owned Rockwell for quite a while. It was much more of an industrial cyclical type company, and what they have done is really embrace the digital transformation that artificial intelligence has afforded them. As a quick example, and I won't belabor the point, but there was an article in another paper over the weekend about a beauty products company and how they had created how they were reshoring and onshoring their operations back to the United States. They were able to manufacture products, simple products, pumps for hand sanitizers and things like that, that over the last 20 years have all been made in China. They were able to bring that back to the U.S. because of automation and advances in AI and machinery within U.S. manufacturing facilities. So that's where we think Rockwell will help drive innovation in manufacturing in the coming years. So
got it. So their customers can be from big industrials to people creating companies creating consumer products.
mostly on the big, larger industrial, they're kind of process automation. And so again, if you and I were, producing machine tools or something at scale, large volumes, we would engage with Rockwell to come in and help us retool our facility to maximize efficiencies, maximize automation, and compete on a global scale on a cost basis, because we're able to make a great product, which they help us design and pull out the friction points, and do so at a price point that's competitive to sell in the global markets. So it's a really interesting company.
Got it. Got it. Yeah. And I mean, it's definitely one that, I hear about it from time to time, but it's not mainstream. It's not getting the
It's not
attention.
mainstream, and it's got some detractors, right? Some people don't like, which kind of makes it interesting to us. We want to find the names that maybe are a little bit of a battleground stock where there's opinions on both sides. Kind of gives you an opportunity to get it at a reasonable price.
Yeah, I mean that's one. So this is one of this is what you would one of these things that you would call innovation. One of these innovation plays.
Innovation at a reasonable price, absolutely.
Innovation. Okay, so you mentioned Oracle. Are there any more that you'd say innovation at a reasonable price?
Yeah, look, I mean, you can't discount Amazon. And we like to think about Amazon because I put an order online at 9 o'clock, and hey, 1 o'clock in the afternoon, I got a whole big box of toilet paper. It's remarkable how quickly they can
It's unbelievable.
They can provide that. It really is, right? But there's so much more to Amazon, and that we either know about and some we don't know about. And the point that I like to raise to people is they're a real innovator, not just in just retail and distribution and logistics, because they've really done some amazing things there. But they're doing things even beyond cloud compute, right? So they own AWS is their cloud compute platform. It's a hugely profitable business. It's growing. It's modular, meaning that it can be utilized by large companies and small companies, because it's kind of like a buffet. You can kind of pick off the buffet what you need and pay for it. But what's interesting to me about Amazon is last year, in research and development spend total, they spent about $75 billion. Okay. That's about 6 or 7 times what Pfizer spent. Right. So they're the leader in R&D spend. So it makes you question, what are they doing in the garage that we don't even know about? Right. So that's exciting to us when you think about a company that has a huge core business, is an innovator, and isn't stop innovating. They generate a ton of cash flow that they can plow back into their innovation efforts to come up with the new next thing.
It's unbelievable. If you think of it, it's unbelievable. And I get scared. I bought more Amazon. I think it was like below 100. I bought more Amazon, and then it's here, and I'm like, do I want to buy it again? And I used to have the thing where I want my price that I buy the stock at to be, I like seeing the percentage gain, and
Sure.
So a long time ago, I just got lucky and bought Tesla when I was in a Tesla 9 years ago or something. And I bought it, and I bought a small amount, and I turned it into a decent amount, but I never bought more in the beginning because I love seeing the percentage gain. So when I opened another brokerage account, then I bought more, which is really dumb. It's not about your percentage gain. It's about, your absolute earnings. But when people look at your account and they see the percentage gain, like, oh, there's your percentage gain, but that's, I'm bringing that story up just because Amazon, like, what are they doing in that garage? What are they doing? And we don't even know it yet. Right. I mean, to your point. So that's interesting. Now, when do you beyond the innovation, bro, do you think there's an ideal portfolio these days? Like, what is the best, like, percentages? Like, I know back in the day, you'd have bonds, checking, not bonds, equities, like 60-40, what they would say. Is there, do you think this has changed, or where do you think this is at these days?
Yeah, I think it's changed. I think the fact that you can get 4.5% to 5.25% in a money market is pretty intriguing, right? We haven't had that in a decade. The fact that you can get 5.5% to 6% on short-term government paper, treasury bills and bonds is pretty intriguing, right? There's a risk-free rate. If you're going to give me 5.5% on bonds on short-term paper, then I have to have a much more compelling story and return opportunity in stocks to take on that risk, right? So,
Right.
in answer to your question, yes, there's more attractiveness in short duration paper than there has been in a long time. Having said that, we still have a bias towards equities. We're a growth firm. We certainly invest across the spectrum in terms of sectors and industry groups, and we like to find, inexpensive, uncovered opportunities. But our belief is that owning a portfolio of growth stocks over a long period of time is the way to build wealth. And you get that compounding effect that you just referred to. If you leave that account, if you leave that Microsoft there and you don't try to be too tactical and move in and out of it, that will compound over time. You may have a period of time where the stock doesn't do particularly well. 2022 was not a great year for Microsoft, but okay, that's one out of the last 10. Over time, stock's going to compound. You're going to make a lot of money.
Yeah. And so to your point is, when these high growth plays, and that's what you say, that's going to create wealth. When you see downturns in the market, like we had recently, what do you suggest for your clients? Do you do anything? Do you buy more, or what do you suggest?
So a little bit of a difference between taxable versus tax advantage. So if you're talking about, you don't have to worry about it because it's in a Roth or a retirement account where you don't have to worry about capital gains taxes. You can be a little more tactical in trimming around some positions. And yeah, if you've had huge wins, should you rebalance your portfolio a little bit? Absolutely. What I'm suggesting is be careful about moving in and out wholesale of stocks, right? If you have conviction in a company, and not just necessarily in the stock, but in their business, if you believe in their business, if you like their products, if you think their products will be attractive for a long period of time, own those stocks, own the stocks of those companies in size for longer periods of time. Certainly be willing to trim when you think they've gotten a little ahead of themselves, pull it back a little bit and redeploy that capital to other opportunities. That's a great strategy, right?
Okay.
But
keep going. Sorry.
Yeah. Well, but be careful about trying to time the market in terms of moving in and out of entire positions or in and out of entire sectors or in and out of the entire market.
Got it. Yeah, I hear you. And so, guys, we're here with Terry Gardner, portfolio strategist, CJ Lawrence. How did you get into the business you're in? Were you always into personal finance, like in school, or how did you end up doing what you're doing?
So it's a little bit of a roundabout start. I was actually serving in the Marine Corps when I left active service in the early 90s, and I got my first job on Wall Street. And I got my first job in a securities research department of a large investment bank. And I, started to learn about balance sheets and cash flow statements and income statements and putting together models and analyzing companies. And that has led me to on a 25-year journey, 25-year plus now journey in analyzing companies and building portfolios in one way or another. And towards the end of that journey, or towards the latter part of my journey, I joined CJ Lawrence in 2014, which is a very specialized investment management. We build portfolios from the bottom up, stock by stock, bottom by bond. So that kind of fits my career path in securities analysis and investment management.
So you guys are different in the sense you're not just looking at portfolio allocation. You're not just buying indexes. You're going into individual stocks.
Correct. We do a lot of work on the macro. We look at the markets. We've got some proprietary models that we use. We like to know the framework in which we're investing, but we like to do a deeper dive into individual companies and own them in our clients' portfolios for longer periods of time.
Yeah, got it. And so, so when markets go down, you don't get nervous right away. You're looking either like I know you said get out of the market total, but you're looking at potentially as a buying opportunity or, like one of the biggest things is, Warren Buffett says, when people are afraid, when everyone's, afraid, buy; when everyone's greedy, sell, kind of thing. Do you suggest that to your clients, or is that a harder thing to do given what the markets are, kind of thing?
It's hard intuitively, right? It sounds great to us, right? But then you're sitting there and you're watching your portfolio decline by 10, 15%. And you're like, where is this going, right? And that's
Right.
where and so I always say, look, the good thing about at least what we do is we fall back on the fundamentals. Where do we think the economy is? Where's it going? Where's inflation? Where are interest rates? What are the valuations on these companies? What have they done historically when they've been in and around these periods? We did some work during the COVID meltdown. If you remember that March period of 2020, the market was in free fall. And we did some work, said, look, every time the market's down 25%, if you bought there, right, you're up I don't remember the number off the top of my head, but you're up meaningfully off that base the following year and thereafter. And we, put that marker in the sand, right? So we do our work. We fall back on the fundamentals when psychology is getting a little bit squirrely in the market,
Mm-hmm.
and we put our marker in the sand where we think stocks are interesting and attractively valued.
Okay, so going with that notion,
Mm-hmm.
if someone comes to you and they're not invested in the stock market, like there's still a decent amount of people that are not invested in the stock market,
Mm-hmm.
what would you say to them? Like you say, you should be in ETFs. Like, what would be like? I don't know. How do you look at that when someone's not invested in the market at all?
Yeah, so I would say, be invested in the market. And I would pull out a chart that would show the market over time and how the market's performed through all these different crises and meltdowns in the past. And if you held on, if you bought the market on the worst day before the financial crisis in 2007, before it really hit in 2008, so you're the worst investor. You bought at the peak.
Yep.
The next year, the thing you're up like 300% today.
So you're still,
if you held
okay.
it, right?
Okay.
So you can look at the different periods of time and say, even if you are absolutely wrong today and you're investing at the peak shorter term, if you have the benefit of time, you should be invested and you should continue to move into the market because it'll pay off over time. Stocks are the best performing asset class over time. You can look at all the data versus stocks, bonds, cash, real estate, etc. So one, get into the market. Two, look, if we think the macro is not particularly favorable, you don't have to dive in. You can wade in. You can dollar cost average. You can work into particular positions. If you are a do-it-yourselfer, okay, you like to build your own, you like to, reglaze your shower by going to Home Depot and getting your own stuff and doing it yourself.
Yes.
Okay. Then
that's not me.
Right. Then that's kind of stick to the easy stuff, right? Don't get too deep into stick to indexes and ETFs. But if you have some money to invest and you don't want to spend all day, every day looking at it, think about hiring a professional, as you would a professional contractor to redo that shower or your house, as you would hire a doctor, as you would hire a lawyer. Think about hiring a professional so that you can go about your life. I tell my clients, go about living your life. Take care of your kids, your career, your families, your homes, and let me worry about your portfolio. And then we'll talk about it frequently, but you don't have the time, the experience, or I think the inclination to do this on a full-time basis every day.
Yeah. And what do you think about ETFs or indexes though? Like, what do you like? How do you look at them?
Yeah, I think they're fine. If you're a do-it-yourselfer, they're fine, right? I think ETFs are a tax-efficient and cost-efficient way to participate in the market versus a lot of index funds, which actually are a little more expensive. So if you're do-it-yourselfer, I think that's fine. Just bear in mind that you're going to get the bad with the good, right? Most of the stocks will go up, but you'll own stuff that you would not own specifically if you had the choice, right? If you buy the S&P 500, you're getting a little bit of 500 companies, some of which you may not want to own. The way to outperform markets over time is to avoid the stocks that underperform and have overexposure to the stocks that perform. So that's what I do as a professional. But if you aren't going to hire a professional or you're going to just be broadly invested, then ETFs, broad ETFs, I think are perfectly acceptable.
Are ETFs tax efficient, or do you get taxed when they pay tax? Do you get taxed on it? How does that work?
They don't pass on capital gains like a mutual fund. So if you own a mutual fund, the mutual fund could be flat for the year, but you may get a bill or you may get allocated capital gains from within the fund that on which you have to pay tax, even though you didn't sell the fund. Okay. In an ETF, that doesn't happen. Those capital gains are not passed on to the investor. So there's a little bit of a benefit there.
So would you, so why for mutual funds what does that happen versus an ETF?
Most mutual funds are actively managed, and people want to pick a manager who they think is going to outperform over time. Most ETFs are passive. So if you just want to own the index, hey, I don't care. I just want the S&P 500 index return over time. I'm going to do it the cheapest way I possibly can. I'll likely find that in buying the Spider or one of the S&P 500 ETFs.
Got it. Okay. So I guess it's like we have a couple more questions. Again, we're with Terry Gardner, portfolio manager. Are you on Twitter?
I'm not on Twitter. I may go back on Twitter. Do you have a lot of your viewers and listeners that follow Twitter?
I don't know. It's some people have it. It's if you have it that I want to make sure we give it out. But
you can all of our content, which we put out for free, right? You've seen some of our videos.
Yep, I saw it.
Myself and my partner Bernhard Kupp, we put out periodic videos about the markets, things that we're seeing. You can go on our website at cjlawrence.com and click them, and we'll tell you what we're thinking at that time. So, I think there's value there. You would have to tell me.
For sure. Okay, if you weren't working on doing something Wall Street related, what do you think you'd be doing?
For work or for pleasure?
For work.
That's interesting.
Or pleasure, I don't know. Either way.
Yeah. Well, if it was pleasure, I wouldn't be sitting here talking to you. I would be at the beach. If it was another job, I love this business as you probably do because you learn something new every day.
Right.
So I'd have to find another walk of life where I'm intrigued and engaged every day. I think the securities business, broadly defined, whether you're an investor, a money manager, an investment banker, a research analyst, portfolio manager, it's every day is something new. You open that paper and it keeps your mind going and it's intriguing and you learn about the world and how businesses operate. So tough to beat this business in my view.
Yep, absolutely. And then this is the next one. What is your worst or your first job you ever had?
Yeah. My first job coming out of college was I went to officer candidate school and became a Marine. That was a great job. And then my first private sector job, I've liked all my private sector jobs. I've spent my career on the street. There's been kind of different moves. If you want to go way back to working in a kitchen, peeling garlic back in high school, that would probably be the worst job.
Wow.
In my professional
peeling garlic in a kitchen?
Yeah, that job didn't last very long. Working nights in a kitchen.
Yep.
You learn a lot, but anyhow, you go home stinky. But I've been blessed with having had a lot of interesting opportunities, all within this securities business, which have all been intriguing and good jobs, working for good people.
Yeah, that's and having good clients, right?
Having good clients, I'm fortunate in that regard.
Because do you spend most of your day doing stock research, or is a lot of it spent talking to clients?
That's a great question. And because our business model is a little bit unique, right? So our clients, I'm the relationship manager, right? My clients, if they have a question, whether they need to wire money or have a question about a stock, they call me. And I'm also the portfolio manager. I'm doing my research. So it's about 50-50. It ebbs and flows. I would say most days is focused on the markets and research. Hopefully the better job I do, the fewer questions my clients have. So that would tilt the mix towards doing, more research and analysis of the market. So I would tilt that way. And we do a lot of client services. I get out on the road. I go see my clients. I like to talk to them because I get feedback from the field. What's going on in the real economy? What's going on Main Street? What's going on in different parts of the country and the world? And it kind of helps me in thinking through what's working and what's not working in markets.
Yeah, you got to talk to people, and that's also how you find some of your best picks. Seeing what people are using, and I'm a golfer, so I like to see how people are using Callaway golf clubs versus the TaylorMade or what have you.
Absolutely.
But those are like some indicators, but then there's always other things you got to look at. But that's being out in the real world versus being behind the computer screen is key. And again, like we said, you can go check out CJ Lawrence. You can I don't know if there's Terry Gardner is there. There's great videos on the site. There's great, very helpful, short, not long videos, and they're very easy to see. If you just Google CJ Lawrence, you'll see it, and you'll learn. At the end of the day, you'll learn. And then if you want to get in touch, you can reach out and get in touch with any of the representatives or Terry himself, and I'm sure he'll help you. And this is what this is about. We try to bring you guys content that'll help you make better investment decisions. I mean, we talked about growth through innovation, investing through innovation. I mean, that's a new way to look at things. And it wasn't just the Microsofts and NVIDIAs. I mean, we talked about Oracle, we talked about Rockwell. There's other companies that, maybe not be on people's radar, that it's like I guess what you kind of do is you set it and forget it, like buy it and stay in the game. Like you mentioned, if you bought at the high and the 87 crash and you held on, you're up 300% or what have you, so that's the hard part. Like people don't want to see there, but if you look at over the last 30 years, isn't it like 10% a year of the market without like missing a beat?
11%, 11+% compounded return for the S&P 500 since, if you took that all the way back to 1928, if you incorporate all, it's still, an attractive wealth creation number.
Got it. Yeah. And it's hard. It's hard in the real, like the day to day. You're like, oh, is this time different? Is this time different? Because I have some money in the market, I have some money in T-bills, and you're like, okay, you get 5%. But if you look at 20 years, no matter what, the market has gone up, and why is that? Just because new money's created and people are buying I guess that's what it is over time. Like new money's created and that money needs to go somewhere. And it's, the market has always been that first choice of the average person, I assume.
I think that's right. And I think, the market is a collection of companies that innovate or die, right? So when you invest, those are the companies that are surviving for the most part. There's some, you can tell, you can do your work and figure out which ones are on their way out. But over time, those companies leave the markets. They go bankrupt. They drop to a different marketplace, over the counter, whatever. So,
but that's true. Innovate or die. I mean, that's what that's like, and Jeff Bezos from Amazon has been saying that forever. He takes a day one approach, and that's why he had so many different products. Yes, he started with books, but it was innovate or die, that, like innovate or die. And when, and he I don't know what book you read. I remember reading about this. He studied the companies in the Dow many years ago, and he looked at, okay, out of the 30 that were there 30 years ago, 5 of them are left or something. And so his strategy is, if you keep doing the same thing, you're going to die, So diversification. Absolutely. And that's why you're a fan of Amazon.
That's why we're a fan of Amazon and the companies like it that invest a lot back into research and development to continue to innovate and continue to extend their lead. And Bezos lives it, right? He doesn't just talk about it, he lives it. And that's what
he does.
I think is intriguing.
He does. I mean, what you just said earlier in the call, you ordered from it, this morning, and the package is there, from golf clubs to diapers to toilet paper to, it's absolutely incredible what they can deliver on the same day. And what does it do to retail? I mean, that's a whole nother, local retail, that's a whole nother question. So that'll be for another time. So I appreciate you. I appreciate Terry. Any last words you want to say to the audience on the Raz Report, Terry?
No, look, the market does feel a little heavy here, right? Don't let it spook you. The market could trade off a little bit. It seems like valuations have extended themselves a little. That's okay. But if you have money on the side that you want to start putting it in a little at a time is a great way to get engaged with your highest conviction ideas, and then, see if you get another opportunity later on in the year.
All right. And where are you based out of?
We're based out of Midtown Manhattan.
Oh, wonderful.
We're on Avenue of the Americas at 54th Street. And if anybody would like to come and visit us, our address is on our website.
Yeah, we have a FinTech Deal Day. It's not necessarily financial advisors, but we have a FinTech Deal Day sometime in November in Midtown Manhattan. I don't know, FinTech deal dates. I think one of those convened things. Maybe you could
Yeah.
stop by and talk to the audience in person. We have about 600 people attending, so should be
Love
cool.
to do it.
FinTech deal date. Yeah. Well, thank you for coming on the Raz Report, and that'll be it for Terry
Thanks
Gardner.
for having me, Jason. Yeah, thanks for having me. Great to be with you today.
Thank you. Thank you.